Very good welcome to this webinar on Prime Central London and the family office investor. My name is Welch from Landmass, and I've got with me today Gary Hersham from Beauchamp Estates, Paul Welch from Large Mortgage Loans, and John Ennis from Foxtons. As you'll no doubt enjoy their wit and repartee, a very eclectic group of individuals, and all of us together with about 100 years of experience in the prime central London market. So hopefully the information that you're going to get in this sort of 30-minute webinar will be from the horse's mouth, from the coalface, and rather than getting fancy statistics from people who just study the market, you'll actually get people who are actually on the ground doing the work, doing the deals, and making things happen. So first of all, where are we on the market at the moment? Well, generally speaking, it seems pretty buoyant. I like to really simplify things, and when people ask me about the market, my standard answer is the world is becoming a more dangerous place, the world's becoming a wealthier place, and London is, and I think always will be, the international city of the world. Clearly that's being played out as we speak. Will that affect the market? I don't think so, but we'll obviously hear from the experts in a few minutes. I think that the closing of the Tier 1 visa was actually much more significant than any constraints on people coming from, obviously at the moment, Russia. But you know, we'll see what the others think about that. Also, where are we going? At the moment, the indices are positive. Stratton Parker think that this year it's going to go up between 5 and 10%, and within 5 years between 20 and 30%. Savills think that 90% of buyers are pretty unhappy with the choice that they have. So there seems to be a lack of stock both for sales and for rentals. So that's my little snapshot. Excuse me, just having a little drink. And really what we want to know is what's in it, and how can we help the family office investor, and in relation, you know, why would they be interested in prime central London? The family investor clearly has risk at the top of their list, as well as also wanting to make money. So capital preservation, I imagine, is very, very important. And we at Landmass, I've been going for about 20 years. We look to cater in 4 different ways to help them. First of all, we can help them source either ready to move in properties, properties for long-term investment, or we can source, which are really our speciality, unmodernized properties where they can find something lower price point and obviously save money on the stamp duty, and in turn have it designed to their own taste and budget. Secondly, if they want to joint venture, as some family offices do, we can work together with them, understand the needs of the investor, the returns that they want, and their appetite. And lastly, if they have properties that need expert architecture, interior design, we have our own design studio in Soho, where we can help them with that. We also have one thing which nobody else in the market's doing, again aimed at the high net worth family office type of individual, and that is where on the design side we've teamed up with 5 other of what I call best in breed companies to offer a complete solution of, on the one hand, architecture, interior design, secondly, home security, thirdly, art security, fourthly, a company that specializes in safes, fifthly, a company that specializes in audio visual and integration, and lighting, and lastly, a company that specializes in looking after the property once it's finished, which a lot of people forget about, but I think is really, really important for buyers, especially if they living internationally, that they've got somebody looking after their boat, after their home, as they would after their boat. So they're not having to worry about things going wrong. So that's a little bit about Landmass. And what I'd like to do now is introduce properly the various members of the panel. I'm going to start with John. Hi, John. Just give a little overview first. So John's, I've actually known John for probably about 18 years. He's been with Foxtons for 20 years. He's now obviously experienced in sales and lettings, but he's now risen up the ranks to become managing director of the new homes division and of their investment division, as well as central London. So a busy chap, he's also since set up a private office for Foxtons, which is aiming at the high net worth individual, offering their services, but in a much more bespoke way. Anything you'd like to add to that, John?
It's very much that. Thanks, Alan. Yeah, I think having worked in the central London markets for over 2 decades, you realise that different stages and different parts of the market and different wealth strategies require different levels of service. So we're undoubtedly known as the biggest agents when it comes to lettings, but through the private office, we're now able to work with a very collaborative approach, a very personalised approach with a lot of discretion. We have a couple of key elements to the private office. Number one is the way we do asset acquisition for clients. The second one is the way we assist with asset disposal. And then there's a lot of clients who actually hold on to stock. So that whole asset management, whether it's property management, whether it's rentals, whether it's working with finance specialists to re-gear and to manage that portfolio. So it's been a very, very interesting few years. In particular, we work with our concierge department, and that's where, working with companies like Landmass, where we have people who want additional advice on what they should buy and what they should do with it. We have access to best-in-class architects, designers, people like Alan, who will come in prior to acquisition, sometimes prior to disposal, and will optimize people's assets. So I think a very full, true, it's often misused, 360-degree service on the way in, the way you hold it on the way out, involving at times 5, 6, 7 different companies to deliver best-in-class service.
That's brilliant, John. And I'm going to ask you a little strange question. If you think of your first week at Foxtons 20 odd years ago, how that compares to a week today in your life at Foxtons?
Radically different. One thing that hasn't changed is we're always faced with obstacles. This market ebbs and flows permanently. And ultimately, it's about relationships. So the key messages I learned back then still are maintained today. You need to have exceptional knowledge of the property market, of the area, of the comparables. You need an exceptional network of people around you, best lawyers, best surveyors, best architects, etc. And then you need to be ready to develop relationships. Where I moved to in my 23rd year now is with a wealth of knowledge, not just of the property market, knowing a contract better than the best lawyers, knowing a building survey better than the best surveyors out there, but it's also having that contact and that network with other people to deliver really, really good service.
That's fantastic. And I'll come back to you in a second with some questions, but Gary, can I go on to you now? If
you must.
If I must. So Gary is an enigma within the prime London property market. He certainly doesn't mince his words. He's a true specialist. He founded Beauchamp 1979. His passion and expertise, exceptional client base, has helped him create what I would like to think is probably one of the most eclectic black books of buyers and sellers within prime central London. And not only that, he's got offices now, not only Mayfair, St. John's Wood, but in Cannes, Saint-Tropez, Mykonos, Tel Aviv, and associate offices in Lisbon and New York. So really spreading his wings, and I think soon he wants to open one up in Monaco as well. And what gives you that drive and ambition, Gary?
What gives me, or continues to give me? I've no idea. I sleep, eat, and drink to think about sales and property and my business. I enjoy every single minute of it. I love meeting people. There's not a day I don't hand out 20 business cards to whoever. I handed one out to a priest this afternoon, a Roman Catholic priest at the Brompton Oratory. They thought I was balmy, but you never know in life. You never know. And quite frankly, whatever one does, whatever work one does, one has to enjoy it. And in my case, I absolutely adore working in property.
That's fantastic. And same question I asked to John. If you imagine when you started your career in 1979, imagine what it was like working the first week when you started in property and how it compares now. How would you describe that difference?
First of all, in 1979, I knew bugger all. I was a whippersnapper. I was 27 or 28 years old. I'd worked for my late father's public company. I had just a year earlier left the Royal Postgraduate School of Medicine. I was super qualified in biology, zoology, applied entomology, and biochemistry, and totally unqualified both in life and in property. But I do remember in those first early months, I was trying my best to get my late father to give me as many of his contacts as he possibly could. And I started on the platform of dealing with wealthy people. So in that respect, what I did 40 odd years ago in terms of dealing with wealthy people, I've continued to do today. But the real truth of it is I had no knowledge. And over the last 40 years, things have changed so much in terms of my own perception of the market, my own knowledge, that it's a completely different world. Although I have to say I'm probably not as correct as I ought to be in this woke world. But then, you know what? I'm old school.
I think that could be said for perhaps all of us in our private lives. That's fantastic. And Paul, if I can just introduce you a little bit first. So again, I've known Paul for probably about 10 years. Met him, I think, initially in the yacht show in Monaco, where he is a frequent visitor as looking after his clients there. He's a bit like Foxtons. He's set up what I call a bit of a disruptive type of lending platform, large mortgage loans aiming at the high net worth individual, generally loans over £1 million. And I think what I like about Paul, whatever the obstacle, whatever the challenge, he keeps going until he finds the solution. Because in life, you know, it's not always that easy. You know, his motto is never give up. His clients come mainly from the UK, the Middle East, and the Far East. But what's interestingly is at least 1 in 10 people looking for £1 million mortgage get turned down, and often because their finances are very complicated and less straightforward, and they need unraveling and presenting in the right way. Is that a fair summary, Paul?
No, yeah, we try and find bespoke solutions, and we've been doing it for the last 20 years since I founded the business. I used to be in private banking, and I thought to myself there was a better job to be done for people 20 years ago looking to borrow more than £1 million. And it'd be like Gary, you know, I've learned so much in the last 20 years, and you continue to learn every single day. And I love people. You know, for me, it's the people first, and then, you know, what do they really want? And then go out and find that kind of impossible, whether it's 100% funding in the 10 to 50 million space, whether it's blended facilities that are 100% or it's negotiating the best rates that are out there. Most clients don't know what's possible. Most people haven't heard of Lombard lending, margin lending, people that are worth 250 million to 750, depending on their banker and their private banker. You know, it's kind of like learning and educating. I think I educate so many people, and then I also educate myself on a daily basis.
And what do you think is the most significant changes between when you first started 20 years ago and to where you are now?
Compliance is such a pain in the arse in terms of risk appetite. It's just ridiculous. I mean, I feel so sorry for what's going on in the world today, but there are normal people that are going to be penalized because of it. So compliance and risk adversity from the banks is ridiculous, I have to say. We're going to set up our own non-bank lender. We're doing it at the moment because it's so wrong. It's ridiculous.
Well, unfortunately, that's the world we now live in.
But it shouldn't be like that. It shouldn't be that bad. I mean, there's risk, but everyone gets so wrapped up in reputational risk, and you can't do this, you can't do that, you can't say this, you can't do this deal, you can't help that person. And that's where sometimes I think, you know, high net worth people that, you know, they are multiple banked, and sometimes country risk, like the Swiss still look after a lot of the world's wealthiest people, and they take a different kind of view. The Western banks are so, what's the word, choosy with what they do and they don't want to do, and they change a lot of the time. You know, it shouldn't be like it is. It shouldn't be such a woke society, in my opinion. And a bit like Gary, half the time you think to yourself, should I say that? Can I say that? Is someone going to sue me? Is someone going to complain to HR? It's just, yeah, enough's enough, really, I think, personally.
And I know we're going to focus on prime central London, but Foxtons is a huge company. How do you manage that woke scenario?
Quite well, I think. You know, we're a very diverse company. We've grown, we've changed, we've evolved, and we represent London, which is a true global city. I echo the sentiments that there's a lot of risk adversity, and there's a very thorough need to investigate every buyer, every seller prior to any transaction. But this has been the same for the last 2-3 years now, Alan. So we're quite used to it with exceptional systems which allow us to deliver. So, you know, there's 12 different AML sort of approver providers. We use a company which is the same as Border Control. So when you come into Heathrow, London City, and you scan your passport, we do the same thing, and it gives us an answer between 18 seconds and 40 seconds. So long as we've got a decent paper trail, and most people in the world now know what that paper trail needs, we can progress. There are companies which are basically being built on blockchain, which will improve digital identity. It needs to. In the UK, it's going to be signed off by the Home Office. So if we fast forward maybe 6, possibly 12 to 18 months, we will move to a point where I hope that things like identity and the ability to proceed quickly is going to improve. So yeah, it's been the norm for us here at Foxtons.
Fantastic. That's brilliant. Gary, can I start with yourself and just ask you what your view is of the present state of the market and how you see it evolving over the next 12 months? You're on mute, Gary.
Look, it's a question that would have been, oh, sorry. No, I'm not on mute.
No, you're fine.
Can you hear me?
Yeah.
You hear me?
Yes.
Okay. Had you asked this very same question before the weekend, a few days ago, I would have been able to give you a very clear and hopefully would have been a very lucid answer. But with what's going on in Ukraine, with Russia's invasion of a sovereign state, with all the markets crashing as they have done, the stock market, etc., it's very difficult to assume that for the short term, the property market will not drop down quite a bit. And it's very difficult to assume that the number of buyers who are in the market, or the types of buyers who are in the market a week or 10 days ago, will have the same impetus to buy and the same desire to buy at the moment. And I think what I'm feeling, what I've heard from very many different buyers of ours, is that they want to wait and see what's going on. And the initial perception I've had from wealthy Americans, from wealthy Chinese in the last 2 days is we're going to wait and see. Had it not been for this particular major world incident, I would have said to you, I think the market's going to go from strength to strength. I think prices are going to strengthen. I think values are going to go up. And I think we're going to have a super duper year in terms of selling property. But this really has put a spanner in the works.
It's really interesting because we're working with different investors, and we shared an investor 3 properties earlier this week with a view to doing a joint venture with them, and he loved the properties, and I messaged him today saying, you know, what does he think, and his response was exactly that, not making any decision at the moment till we know what's going to happen. So really concur with you on that. And what's your thoughts, John?
It's a live event, and I think it's very early days to make proper predictions. Not at this level, as in, you know, what Russia has done, but we have faced over many years, many different scenarios, and a couple of interesting things come off the back of that. Firstly, there's a very large global audience which look at London, and there are many people from around the globe who are still looking to buy. So we've actually seen a huge number of offers continue to come through over the last 24 and 48 hours. The second bit is there will be some sellers who want to sell, and I think that will present some really interesting opportunities. There are some people who buy risk, so they say, listen, I like it, but I'll buy it for X price. And there's some people who buy time, so they agree a price, agree a contract, but they may not proceed to the point of exchange. That's the pause we're seeing. So we do have some deals in our pipeline where people have gone, I'm ready, but I want to wait a couple of weeks just to see what happens. We've seen some people say, I'll buy it but at price X or price Y. But we have seen a huge surge in valuation requests, massive surge in valuation requests. And we imagine that. So that's a classic where Londoners who hold London property want us to come through the door to say, what's going on out there? What's the value of my property? We haven't seen that translate into a huge surge in instructions. In actual fact, if you look at year on year, to echo what Gary was saying, if you asked me last week, we were 50% up on valuations, 13% down on instructions, and yet the pipelines are ballooning, volumes are ballooning. That will put pressure on prices, or would have put pressure on prices until the events of the weekend. So a live event, we need to see how the different measures that the EU and NATO, etc., react to that. But to echo what I did mention there, we are seeing some, you know, London focuses on the globe, you know, and we have people who need roofs over their heads. So we're very strong in the letting side of things. So people need a roof over their head. They may not choose to buy. They may choose to rent instead. So we're sort of positioned ready for a number of different outcomes.
That's brilliant. And Paul, from the lending side, how are you finding everything?
Well, for the last 6 months, we've seen a lot of banks who no longer wish to extend lending facilities to Russian clients. And for me, there's going to be a lot of facilities, and probably may come onto the market where people will be forced sellers because some of the banks don't want to have Russian clients, as an example. And I can think of 3 scenarios at the moment where people are looking to refinance assets that are worth 10 to 30 million, but the banks no longer want to bank them. And I if that trend continues, then it's going to be really interesting to see what becomes available, but it probably won't be known because most of them will be off-market transactions. In terms of lending, swap rates have already priced in lots of Bank of England base rate rises. You know, if you're looking to borrow 5 million plus, you need to really think of your bank and how it's capitalized to get the cheapest money. So if you're a Lloyd's private bank, Barclays, HSB, so the high street lenders that have a premium offering, you can probably get 5-year money around 2%, But if you're a JP Morgan, Credit Suisse, UBS type institution, you have the margin and the cost of swaps. So if the cost of margin is 1.5, you're paying 3, when really you could be paying 2 for your money. So the price differential for a private client, high net worth person borrowing 10 to 50 million is going to be, and there is a massive differential between what they pay. So, you know, base rate will go up, whether it will go up as quickly as what was forecast. Some people don't realize this, but 10% of the world's wheat is grown in the Ukraine. So that's going to lead to higher inflation, energy costs, higher inflation. And I really would be interested to see what the Bank of England does at its next meeting on the 17th of March.
And what impact do you think will these rising rates of interest have on the market?
Well, for super rich people, it doesn't really matter, to be honest. You know, they have the wherewithal to buy irrespective of. My greatest concern is normal people that may have mortgages in the 300 to say 1.5 million space that have bought in the last 2 years stamp duty, but their debt costs have been sub 1%. So if base rate does go to say 1.25, 1.5, plus a margin of 1, and let's say it's 2.5, next year and the year after, they're going to get a massive mortgage rate shock where they may have been 2 or 3 year money and their mortgages will double or triple. That's the pain that could come for normal people. Sure. Super wealthy, from my experience, you know, probably have a lot more flexibility. Lombard lending, we're seeing a lot of Lombard lending where people can custody assets on one side of a bank's balance sheet and lend out as little as 50 basis points. So, you know, if you've got the wealth, you can mitigate the cost by doing what we call a blended facility, where you use debt, like the property, plus shares, bonds, and portfolios. But those people that have leverage may get margin calls with the stock markets falling. So it's a fascinating time, and you know, if you've got facilities expiring in the next 6 to 8 months, now's the time to be doing something about it.
That's really interesting. From a risk-averse point of view, capital preservation, investing in prime central London on the letting side, how do you see the market at the moment, John? And what would your advice be for anybody wanting to invest for a long-term capital appreciation and rental income?
So the people who are investing in prime central London, you know, interest rates are you know, a very key factor and will cause a squeeze on yields. Interest rates will also cause a squeeze on disposable income. But in the prime central London markets, people are buying for different reasons. They're buying to park some cash, to buy sterling, and they're buying for medium to long-term reasons. One of the largest reasons is retirement, the social life and the fun factors of London, or it might be for children and generational wealth. So it's very, very rare we see huge levels of debt. It's very rare that we see 70, 75% loans. And if you do, they could just as easily buy it in cash, but they go to speak to people like Paul and realize, wait a minute, my cash can work better elsewhere. So London yields are probably working. If you look at prime central London, somewhere between 0.5 to 1.5% yields. If I look at prime London, so outside of the Kensington, Chelsea and Westminster, we're looking somewhere between 1 to 3% yield. So people are not buying for the out and out yield. However, they are getting a bit of capital appreciation if they buy well, and they are buying a place that they can utilize in London, call London home, and most importantly, house their children and make sure they've got a really lovely roof over their heads.
And what's the state of the lettings market at the moment?
We're rampant, not enough stock, which I think is a generic point out there. So good quality stock is really important. We launched the lettings arm of the private office in January, and they're off to an absolute flyer. We've got 5-year deals coming in at £4,000 per week, and people bidding on houses at £25,000 per week. So you've got, you know, it's some really, really interesting deals coming through. There's still a large global audience, but there's also a lot of people domestically who've done very, very well. A lot of people have sold companies. Some people have generated wealth through buying very, very well during the dips of the COVID pandemics in 2020 and realizing those numbers. Some of the banking community have done exceptionally well. So whilst they might be a little bit risky of where the stock markets are heading right now, they have performed very, very well over the last 12 to 24 months. And then you've got some people coming through with, crypto assets. And if they can show a really good linear path of where their money came from first, how their money has grown through crypto, and then they brought that crypto back into fiat currencies, pounds, dollars, euros, and realize that cash properly and legitimately. We've got people who've come into quite a bit of money, and a good place to store that is property gold, good old central London.
That's great. And Gary, if I can, during the COVID pandemic, there was obviously an appetite for people to move out of London. And are you finding that they're now wanting to move back into London? And what's the financial impact for them if they have now decided to move back?
I'm not actually seeing people moving back, because in the line of work that I do, in the type of properties I sell, the buyers who've moved out of London have not sold their houses in London, bought another property outside London. So yes, quite a few of them are spending more time in London than they are outside London. But I'm actually seeing less requests, but I'm getting more requests for lots of land, hundreds of acres of land, with or without a house on it outside London, so somebody can build his own house or have a spectacular house. But also at the same time, quite a lot of requests for big houses in prime central London, if possible. It's more likely to be St John's Wood and North London, Hampstead, etc., for houses with superb gardens. I think there's a great demand for outside space, whether it's in London or in the home counties or outside London.
And what about these some of these new developments which are being branded by different designers or companies? Are you finding that people have an appetite to pay the premium price for those types of things?
Well, there are two, I don't know if you're going to refer to two of them. There are two spectacular new developments that are going on the north side of Hyde Park, which until very recently was, and with the exception of Hyde Park Gardens, was a very much a no-no area. You've now got the building that is the concrete frame completely up, overlooking the park, Park Modern, where you've got a building that is second to none in terms of what it provides internally and facilities, but on the north side of the park. And I'll just come back to what I think in a minute. And then you've got, dare I say it, an even better scheme in the new Whiteleys. The new Whiteley scheme is out of this world, is absolutely spectacular. But you and I will remember the days that the area, the Queensway area, was for ice skating, Chinese restaurants, and the less affluent of the Arab nations. All of a sudden, there's 13 or 14 million being spent on by the council on Queensway itself. The Whiteley scheme is, I'm telling you, incredible, absolutely incredible. The whole road is moving up notch by notch by notch, unbelievably. And therefore, coming back to your question, will it compete with the likes of number 1 Hyde Park, the Knightsbridge, and other schemes on the south side of the park? Absolutely it will. And I've got an American coming over. It's taken me on Monday. It's taken me weeks to convince him, come and have a look at Whiteley's. Oh, it's not the right. I've heard the area is not right. Come and have a look at Whiteley's. They're sending the Bentley to collect him. It's going to be, I'm almost sure I'm going to close a sale there. It's spectacular. So your question is a very good question and absolutely spot on. I think it's going to very much compete with the south side.
You know, I think people at obviously at the higher end, the facilities that they're looking for, the facilities they expect are becoming more and more infinite. And
well, for example, Whiteley's got 6 sensors running the hotel, 110 key hotel run by 6 sensors.
Yeah. You know, are you finding that also, John, at the higher end?
I think there's a massive demand for the new builds. There's really, really good quality. I think the last 5 years, off the back of projects that Gary's mentioned, the Knightsbridge, One Hyde Park, it set new benchmarks, and it sort of put London right out there. And there are 5, 6, 7 schemes which are either under construction or recently delivered for the discerning clients, which also come with best-in-class facilities surrounding them and really, really good places to eat. You know, you've got historic buildings such as the OWO, you've got the Bryanstons, you've got all different styles. So, and the all different styles cater for the planet. So whether people want period, they want glass, they want lateral, they want an excess of space. And to echo what Gary said there, we're also finding people looking for very, very large units. So there's, you know, if you go back 4 or 5 years, it was rare to find a property north of 3,500, 4,000 square foot. You know, if you look at Victorian architecture, you know, the majority of these buildings are 20, 21 foot wide, many of them 18 foot wide, and vertical living. So to suddenly be able to buy 5, 6, 7,000 square foot is very, very rare and very, very unique. There are only certain pockets where you can get that as a house, St John's Wood, Hampstead, etc., etc. You know, most around South Kensington, etc. Again, is sort of vertical townhouse living. And so these new builds have started to craft a bit of a sort of niche where they have put together some pretty spectacular units. But the clients, therefore, if they can get the additional facilities and the additional servicing, it's a bit of a win-win for them. So very unique products. They, you know, they come at a price premium, but so does taking a boat, so does going to the best restaurants, so does taking a private jet. And now the resi world, the property world here in London, is sort of up in a similar category as the rest of the rest of those asset classes.
See, that's interesting, because Landmass as developers were actually looking at a project in W2, which is a grade 2 listed building, and the apartments would all be sort of 4, 5, 6 bedroom apartments. And you know, in the past, most investors would shy away from that, saying, no, we only want to invest in smaller units because they're easier to sell. But in fact, you know, because of a lack of supply of these larger apartments, it actually could be the opposite. That you could actually get an increased premium for larger properties. I don't know. What do you think about that, Gary?
Well, let's just go back a stage. I'll tell you 2 things. First of all, if you look at the mansion blocks that were prevalent and are still prevalent in prime central London, from St John's Wood through to Chelsea, wherever you like, only 2 or 3 rooms have decent external views, and the rest go back like a train. And those were the buildings where you could get the larger apartments, 4 and 5, and maybe a small 6-bedroom apartment. But nobody wants those anymore. They don't want those. What is happening is, you have to remember that the very rich are super rich compared to when to wealth in the 90s and the 80s. And quite frankly, those sort of buyers, perception is reality. If they see an apartment at £40 million or £30 million, they want it, they will buy it. And I just see the market going very much further forward in terms of new build blocks. With the Whiteleys, for example, it's got 16,000 square feet on 1 floor of leisure facilities, 16,000 square feet just on 1 floor, 1 level of leisure facilities with almost Olympic-sized swimming pool. It's unbelievable. People's perception, the wealthy people's perception is, if they want it, they buy it. Not tomorrow, not yesterday, immediately, when they wake up in the morning. And I think this is going to be the way of the world. Plus, with everything that's going on in the world, the super security that these buildings offer.
If you could fast forward, Paul, thanks, Gary, 12 to 14 months, what do you think is going to drive the influence of the buyer at the top end in the future?
I think it's going to change, because they've got the money to buy if they want to buy. So for me, going back to what John mentioned in terms of using leverage, the best time to use leverage is the date of completion, because it helps mitigate inheritance tax planning. And also, there are digital asset lenders that now lend against Bitcoin and cryptocurrencies. So we work with a Swiss digital asset lender that will lend money against coin, sub 40% loan to value at 4%. So the world's wealthiest, if they, like Gary says, if they want to buy it, they buy it. It's irrelevant. And if they've got 5 homes, 1 in New York, 1 in London, one in the Alps for skiing, one in the south of France. You know, it's never that to me that hasn't changed. It's just that some of these people have made so much money. You know, like crypto. I spoke to a guy recently who put a couple of £1 million, call it 10 years ago. That position's nearly worth 200 million. He bought coin 10 years ago. You know, and there's a lot of people that have made a lot of money very, very quickly, and they buy what they want. I don't see that changing.
So the key is really creating the right product that they want to buy, because, you know, what I say is that anybody wanting to buy in prime central London or rent, they already have a roof over their head, so they don't need to. So if they don't like what they see, they don't haggle on the price. They just say to the agent, what else do you have? And it's very much, you know, what I share with my design team. It's an emotional purchase. So you've got to get it spot on. Some people are visual, some people are auditory, some people go by smell, some people by taste, and some people by touch. And you have to find ways as a developer of touching all these different aspects. And, you know, as Gary says, you know, with the Whitelist project, having 6 senses in, I sort of rest my case, because you're there, you know, looking at all the different senses that people have in order to attract them to the right home. And how would you see, John, just to sort of finish off, you know, the aspirations of people in 12 to 14 months? Do you see it the same as today, or would you also see it a little bit different?
I think every human at some point wants something different and something better. And we've seen that in terms of product design, in terms of cars, boats, yachts. They get very, very used to best in class quickly. And therefore, they want something newer, shinier, bigger, grander. So it'd be really interesting to see how the house builders and the key developers work towards that. One thing I think which would echo with everyone on this call is some of these best in class assets are not always actively advertised. At times, there is a large marketplace of very discrete assets, whether that's houses, not always in the new build world, but in terms of availability. So I'd always urge people to reach out to people who are really clued up and in the know, who can sometimes unlock doors. And what we have noticed is the concept of deal making. So there might be somebody who's got a house at 25 million who doesn't want to sell. But suddenly, if you speak to them, find out what they would do if they sold it, find them something to move to, and have a conversation, suddenly you create deals, you know. So don't always just think you can find what's out there.
That's the nature of good agency.
Absolutely.
Yeah,
Gary.
I mean, talking of deal making, Gary, you know, you're probably a little bit of a connoisseur, but just to sort of wrap up, because we're coming to the end of our time limit. I'd just like to ask one of you, so each of you, if you to give one piece of advice to a high net worth individual looking to buy a home in London, either for themselves or for investment, what would that one piece of advice be? And if I could ask, first of all, Paul, what advice that would be?
I mean, for me, it would be borrow as much as you can and for fix as long as you can. So 10 years, borrow as much as you can, fix for as long as you can. Helps with AHT planning, and these sort of clients can make more with their money doing other things than paying cash, would be my advice.
That's brilliant. John?
I'm going to use the words of Sun Tzu in his book, The Art of War, which is, I'll paraphrase 2 bits. First one is be ready, you do your research, have good connections. And secondly, when you see it, strike like lightning.
Fantastic. And Gary, always like to have the last word. What would your piece of advice be?
One would expect me to say the art is in the buying. But when you're dealing with very high net worth individuals, the art might be in the buying, but so what? The art is not to lose. I remember selling a house to somebody and I said to him, I will buy it for the best price. And he turned around and said, no, that's not what I want. I want you not to lose the house for me, not to lose the property for me. And as we've just said a moment ago, I think the most important ingredient and the advice I can give, if you see something you like, don't try to be a clever dick. Don't try and steal it. Buy it. If you want to negotiate a little bit, but get there and do it straight away.
That's fantastic. I have to say, before we started this webinar, I wasn't sure how it's going to evolve, but I really think it's been an interesting discussion. I hope the viewers also, of course, most importantly, find it interesting and stimulating. I'd like to thank Paul, John, and Gary, and most of all, Ty Murphy, for having allowed us to present this and put it together. I'm privileged to host it, and hope that you enjoy it, and thank you very much for listening.